Okay, for our discussion today, we will be discussing property, plant, and equipment for SMEs. Again, our standard for this is the IFRS for SMEs. And let's start. PPE are held for use in the production or supply of goods or services for rental to others or for administrative purposes. PPE are expected to be used during more than one period. Therefore, their classification is a non-current asset in our balance sheet. So for our recognition principle, the entity shall recognize the cost of an item of PPE as an asset if and only if there is probability that the FEB or future economic benefits associated with the item will flow to the entity and the cost of the item can be measured reliably. Again, these two should be established before there is a recognition of your PPE. An entity shall measure the item of PPE initially at its initial measurement of cost, including its purchase price, including legal and brokerage fees, import duties, and non-refundable purchase taxes after deducting trade discounts and rebates. It also includes directly attributable cost to bring the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. And also, it includes the initial estimate of costs of dismantling and removing the item and restoring the site on which it is located. Again, our guiding principle is the expense necessary for it to be in its condition as intended by the management. But we have to take note of the following. They are not to be capitalized but to be expensed. For cost of opening a new facility, cost of introducing a new product or service, cost of conducting business in a new location or with a new class of customer, administration, and other general overhead costs. And take note, for this item, this only applies to SMEs. Borrowing costs are expensed under SMEs, but for full PFRS, borrowing costs are capitalized for PPE. Now, for our subsequent measurement, we only use cost model or evaluation model. We all know that the cost model is cost less any accumulated depreciation and any accumulated impairment loss. Whereas the fair value model or evaluation model, it should be at the revalued amount or fair value, being its fair value at the date of revaluation less subsequent AD and subsequent accumulated impairment loss. Revaluation shall be made with sufficient regularity to ensure that the carrying amount does not differ materially from that which would be determined using fair value at the end of reporting period. Just a trivia, before the 2006 or before your current IFRS for SMEs, there was only cost model. After one amendment, now the SME can use the revaluation model. The revaluation model, the assets carrying amount is increased as a result of revaluation. The increase shall be recognized in OCI or other comprehensive income and its accumulated amount under the heading of revaluation surplus in the equity. Therefore, you can see the revaluation surplus in your balance sheet under the equity section. On the other hand, if it is decreased as a result of revaluation, the decrease shall be recognized in P&L. However, the decrease shall be recognized in OCI to the extent of any credit balance in existing in the revaluation surplus. Therefore, exhaust first the existing balance of RS before you go to P&L for revaluation decrease or decrease using revaluation model. For the depreciation method for SMEs, an entity shall select a depreciation method that reflects the pattern in which it expects to consume the asset's FEB. The possible depreciation methods include straight line, diminishing balance, and a method based on usage, such as the units of production method. If there's an indication that there has been a significant change since the last annual reporting date in the pattern by which an entity expects to consume an asset's FEB, the entity shall review its present depreciation method. And if it's not touching base with the realistic performance of the asset, the depreciation method should be changed in order to reflect the new pattern. So we account for that as a change for or change in accounting estimate. So we account for it prospectively. We have our first sample problem. An entity purchased an equipment on 1/1/22 for 5 million. The equipment had a useful life of 5 years and the residual value of 600,000. The policy is to depreciate the 5-year asset using 200% double declining for the first 2 years, then switch to straight line. What amount should be reported as an accumulated depreciation as of or on December 31, 2024? So there's a change in accounting estimate. So for first 2 years, you're using the 200% double declining. Take note that our depreciable amount is equal to the running balance of our carrying amount. And how to compute the 20% rate? That is just 1 divide life or 1 divide 5, which is 20%. Now, this is 200% double declining. Double the 20%, you get the 40%. Therefore, the 2022 depreciation expense is the 40% of the carrying amount or the initial carrying amount of the equipment, which is 5 million times 40%, you get 2 million. And the carrying amount as of 12/31/22 is 3 million. The 40% of that would be 1.2, with an accumulated depreciation as of 12/31/23 of 3.2 million, carrying amount of 1.8 million. As of 2024, there was a switch of depreciation method from double declining to straight line. First, recognize that your previous method did not account your residual value. But in straight line, we have to include or consider the residual value. So your up-to-date carrying amount is 1.8, deduct it with your residual value of 600,000. Your depreciable amount is 1.2, and the remaining life is 3. How to get 3? The life is 5, less the age of 2 years. Your remaining life is now 3. So your depreciation expense for 2024 is 1.2 million divide 3, that's 400,000, resulting to an accumulated depreciation on 12/31/24 of 3.6 million. 2 million plus 1.2 million plus 400,000. Total of 3.6 million. Now for our next problem, an entity purchased equipment with a cost of 10 million on January 1, 2022 with a useful life of 10 years and no residual value. Entity used straight line. On 12/31/22 and 12/31/23, the entity determined that the impairment indicators are present. There is no change in useful life or residual value. On December 31, 2022, the FVLCD or fair value less cost of disposal was 8.1 and the value in use is 8,550,000. So on 12/31/23, you're also given the FVLCD of 7.9 million and the VIU or value in use of 7.7 million. So as a review, the first question is the impairment loss for 2022. So what happened? You acquired an asset or a PPE or specifically an equipment on 1/1/22, 10 million with a useful life of 10 years. So we first get the depreciation of 1 million by dividing 10 million with 10 years. So you get 1 million and the carrying amount of 12/31/22 is 10 less 1 million, you get 9 million. You compare it with your recoverable amount, which is the higher of fair value less cost of disposal and value in use of that date, or which is 12/31/22. So the higher would be rather is 8,550,000. Deduct it with your CA, there is a difference of 450,000 as your impairment loss or RALCA. The RA is less than the carrying amount. The next question would be, what amount of gain on reversal for the impairment for 2022? So, continuing that, you have, as of 1/1/2023, your new carrying amount is 8,550 because it was already impaired. Now, for 2023, your depreciation would be 8,550 divide how many years? The remaining life of 9 years. 10 minus 1 because the age is 1 year. You get a carrying amount of 7.6 million. Compare it with your 7.9 million. So what is the use of this presentation of CA of 12/31/23 of 8 million in your right side of the screen or the presentation? So for impairment, and if there is a subsequent impairment from your previous or initial impairment, we have to check the limit for our gain on reversal. It is no longer a comparison of your FBLCD and VIU. it should be compared with your carrying amount as if there was no impairment from the beginning of its original uh, life. So our original cost and our original or start of the service of your PPE is 1122. So if there was no impairment on 2022 and subsequently we are now at 12/31/23, the carrying amount is just 8 million. So just to check, 7.9 or 7.7, whichever might be the RA or recoverable amount, it should not be more than the original carrying amount. Should have been there no impairment. So it's just below or less than the CA of 8 million. So we proceed to whichever is higher of FBLCD and VIU, which is 7.9. So 7.6 compared to 7.9, you get a reversal of 300,000. Now for the depreciation for 2024, again, on that date, it's already 7.9 because there was a reversal. So from 7.6, you have now a carrying amount of 7.9 and the depreciation now would be 987,500 divided by 8 years of remaining life. Next, we still have another sample problem. On 1122, entities showed land with carrying amount of 10 million and a building with cost of 60 million and accumulated debt of 18 million. The land and building were revalued on the same date, which is 1122, and revealed that the fair value of land is 17 million, while the building as 70 million. The original useful life of the building is 20 years, and the depreciation is computed on straight line. Our first question is, what amount should be reported as pre-tax revaluation surplus on that date, or 1122? Your land initially at a carrying amount of 10 million was increased to a fair value of 17 million. There is a revaluation surplus of 7 million. From 10 or 17 million less 10, that's 7 million. For your building, the 60 million is your cost and your accumulated debt is 18 million. With a carrying amount as of 1122 or the date of revaluation, you have a 42 million. You compare that with your 70 million. Take note that the table for evaluation, for PPE, for depreciable assets, you put the fair value sa baba or katabi ng carrying amount and not the cost, original cost of 60 million. Because if you put 70 million beside 60 million, you will get a different answer. Again, this is just a review of what you've learned under your FinAct for full PFRS. So the 70 million should be compared with the carrying amount, which will result to a 28 million evaluation surplus. 70 less 42. So the revaluation surplus on the revaluation date or revalue date at 1122 is 7 plus 28 million equals 35 million. Take note, this is just pre-tax and there was no tax rate given. If you'll be given a tax rate and the question is silent, I think it's fair and it's just to apply post-tax or apply the tax implication. Because what would be the intention of the problem of putting a certain tax rate if they will not consider it? So just a advice if ever there's a tax rate. Next question, what would be the amount of pre-tax revaluation on 12/31/22? So after a year, what happened with your revaluation surplus? So there's a piecemeal realization of RS if it's a depreciable asset. In this case, only the building is a depreciable asset and land is not. So we reflect also how do we depreciate it. We have to apply it also in our piecemeal realization of revaluation surplus. So just to take note how to get the remaining life, you were given an 18 million accumulated debt. As a learner of accounting, we know that accumulated depreciation is a representation of the age of the asset or what has been the experience of the asset or service to the entity. So the 18 million should reflect the age or the used life. So 18 divided 60 million is 30%. And we are given with the original useful life. So we multiply the 30% to 20 we get the age of 6 years, meaning that 18 million is good for 6 years already. So the remaining life is already at 14 million as of 1/1/22. Therefore, your remaining RS as of 12/31/22 is now 33 million. How do we get that? The 2 million is solved by 28 million divide 14 million. You get 2 million. So the initial RS at 1/1/22 of 35 million must be decreased by 2 million, resulting to a pre-tax evaluation surplus on 12/31/2022 of 33 million. To journalize, we debit RS, we credit it to RE of 2 million. The last question for that problem would be, what amount should be reported as the depreciation expense for 2022? Again, the carrying amount of your building is already at 70 million because you've already revalued it. So you'll not be using the 42 million. So 70 divide the remaining life of 14, you get 5 million. Nothing new, debit depreciation expense, credit, accumulated debt. Now for our intangible assets for SMEs, we're still using the IFRS for SMEs. An intangible asset is an identifiable non-monetary asset without physical substance. First, it is separable, capable of being separated or divided from the entity, and sold, transferred, licensed, rented, or exchanged, either individually or together with a related contract, asset, or reliability. Meaning, these are the manifestations that you can say that the intangible asset is separable. It also arises from a contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity or other rights and obligations. Now, if and only if it is probable that the FEB or expected FEB are attributable to that asset will flow to the entity if the cost or value of the asset can be measured reliably and the intangible asset does not result from expenditure incurred internally on an intangible item, you recognize IA. Take note that it is different from your usual asset recognition principle. We are used to having the first two criteria for asset recognition principle, but not the third one. This is uh, unique for our intangible asset. It must not result from an expenditure incurred internally. So be guided. For initial measurement for intangible asset, it should include the purchase price, including import duties and non-refundable purchase taxes after deducting trade discounts and rebates, any directly attributable cost of preparing the asset for its intended use. If an intangible asset is then acquired in a business com, the cost of that intangible asset is its fair value at the acquisition date. If acquired by way of government grant, the cost of that IA is fair value at the date of the grant is received or receivable. If an intangible asset is acquired in exchange for a non-monetary asset or assets or combination of monetary and non-monetary, an entity shall measure the cost of such IA at fair value unless the exchange transaction lacks commercial substance or the fair value of neither the asset received nor given up is reliably measurable. In that case, the cost of the asset is the carrying amount of the asset given up. The entity shall recognize expenditure incurred internally on an intangible item, including all expenditure for both R&D or research and development activities as an expense when incurred, unless it forms part of the cost of another asset that meets the recognition criteria in the standard. So if there's an R&D, check if pwede na ba siya ma-recognize as IA. If not, UPNL or recognize the R&D in your P&L or expense as incurred. The entity shall recognize expenditure on the following items and expense and not capitalize as IA. So if it's internally generated brand logos, publishing titles, customer lists, and similar in substance items, startup, training, advertising, and promotional activities, relocating and reorganizing part or all of an entity, and bawal si internally generated goodwill. It must be expensed and not capitalized as IA. An entity shall measure IA at cost less any accumulated amortization and accumulated impairment loss. So for the useful life, this is pretty unique for SMEs. For the purpose of this standard, all IA shall be considered to have a finite useful life. So walay infinite for SMEs. The UL or useful life of an intangible asset that arises from contractual or other legal rights shall not exceed the period of the contract or those other legal rights, but may be shorter depending on the period over which the entity expects to use the asset. If the contractual or other legal rights are conveyed for a limited term tapos renewable, the useful life of the asset shall include the renewal periods only if there is evidence to support the renewal without significant cost. If the entity can afford to renew or not so material cost, we include the renewal periods. Okay? But if the useful life cannot be established reliably for PPE, the first priority is management's best estimate, but it shall not exceed 10 years. So for the residual value in IA, an entity shall assume the residual value of an IA is zero unless there is a commitment by a third party to purchase the asset at the end of useful life. Hence, merong RV. Unless there's an active market for the asset and the RV can be measured or can be determined by references market. And it is probable that a market will exist at the end of the useful life, meaning there's a fair value or for that certain asset at the end of its useful life because there's an active market. For these two instances, the RV is not zero. But if those two are not existing, there's no commitment by a third party, there's no active market, the RV of intangible asset is zero. For retirements and disposal, an entity shall recognize an intangible or de-recognize an intangible asset and recognize gain or loss in the P&L on disposal or there is no future economic benefits expected from its use. So there is a de-recognition in your P&L. So let's have our sample problem. On 1/1/2019, SME acquired trademark for 3 million. The SME expected to continue marketing the line of products using trademark indefinitely. Management is unable to estimate the useful life of such trademark. So in 2022, a competitor unexpectedly revealed a technological breakthrough that is expected to result in a product that when launched by the competitor will extinguish, meaning it will make your trademark useless for SME's patented product line. Demand for SME's patented product line expected to remain strong until 2024 na lang when the competitor is expected to launch the new product. In 12/31/22, SME assessed the RA of the trademark at 500,000. SME continued to manufacture the patented products only until 12/31/24. For our first question, what should be reported as amortization for 2022? So originally, it was acquired 2019. So it was not set by the management. So we use 10 years. So as of 1/1/22, after 3 years, you have an accumulated debt of 900 deducted from your original cost of 3 million. Your carrying amount is now 2.1. Now, as of 2022 or during 2022, you happen to notice that your life or the patent's life or trademark's useful life will only last until 12/31/24. So there's no longer uh, reason if you still want to use the remaining life of 7 or 10 minus 3, but only 3 years because you're only expected to use or there's only a expected probable FEB or future economic benefits lasting only for 3 years. So 2.1 must be divided by 3 and not the remaining life of 7. Therefore, your amortization for the year 2022 is only 700,000. Next question would be impairment loss for 2022. After deducting your 700,000 amortization expense for 2022, you'll get a carrying amount of 1.4 million as of 12/31/22. It was given in the problem that on such date, the recoverable amount is 500,000, resulting to an impairment loss of 900,000. 1.4 million carrying amount less recoverable amount of 500,000, impairment loss of 900,000. So that's it for intangible assets and PPE. Thank you.